Hello, and welcome to the Deep Dive. Today, we're tackling a huge one, U.S. Treasury bonds, a topic that, well, really touches every part of the global economy. You've asked us to go right from the beginning, the absolute basics, and follow the thread all the way to the big financial, economic, and even the geopolitical ripples.
That's right. Our goal here is to navigate through the sources you've given us, piece it all together, and give you a clear, sort of logical picture of how these bonds shape things.
Okay, great. So let's kick things off. What exactly are U.S. Treasury bonds? Why are they such a big deal?
Right. So at their heart, they're basically IOUs from the U.S. government. Long-term ones, usually maturing in, say, 20 or 30 years. They pay interest twice a year, a fixed rate. And their big claim to fame, really, is that they're considered almost risk-free.
Risk-free because the U.S. government backs them with its power to tax, right?
Exactly. That backing is key. And the yield on the 10-year Treasury, that specific one, acts as a kind of global benchmark. It tells you a lot about what the market thinks is coming down the pike regarding inflation, economic growth, and what the Federal Reserve might do.
Got it. So they're fundamental. Now, the pressing question, what's actually moving these yields right now? What forces are at play?
Well, there are three main drivers we're seeing in the sources. First up is U.S. fiscal policy and, importantly, the national debt. Your sources mentioned talk of a potential big, beautiful bill, one of those massive spending packages. And that could add trillions more to the deficit. We could be looking at debt hitting something like 116% of GDP by 2034.
Wow, 116%?
Yeah. And think about this. Just servicing that debt, paying the interest, now costs around $478 billion a year.
Wait, more than the defense budget?
More than the defense budget. That's a huge chunk of change not going elsewhere. It puts real constraints on future spending and definitely pushes long-term yields up. Investors need more incentive to lend for longer periods when the debt pile is that big.
Okay, that fiscal pressure is clear. What about the Fed? How does monetary policy play into the long-term yields specifically?
It's interesting, right? Because the Fed has a really strong grip on short-term rates. But long-term yields, they're more about what the market collectively believes about the future growth, inflation, that sort of thing. So even though people might expect the Fed to cut rates maybe late 2025, the market seems to be saying, hold on. The U.S. economy's been pretty resilient. Maybe inflation stays sticky. Maybe growth holds up better than expected. Plus, there's this thing called the term premium. It's the extra yield investors demand just for the uncertainty of holding bonds for a long time. And that seems to be rising too.
So investors are demanding more return for locking money up longer, regardless of what the Fed might do in the near term.
Pretty much. It reflects a kind of fundamental uncertainty about the longer-term picture.
Okay, so we have fiscal pressure, monetary expectations. What about the third piece? Trade policy and tariffs. That often seems a bit disconnected, but your sources link it.
Yeah, they do, and it's a fascinating angle. The current sort of aggressive trade stance with talk of average tariff rates jumping significantly, maybe from 2.5% now up to 7%, or even, well, nearly 18%.
That high, really?
Potentially. And that acts as a drag on growth, makes businesses hesitant to invest. But here's the twist. Normally, in times of stress, money flows into U.S. bonds, the safe haven, pushing yields down. But these trade policies, the sources suggest, are actually weakening the dollar somewhat.
Oh, interesting.
And making bonds less attractive to that safe haven. We've actually seen yields rise sometimes, even when stocks are falling. It's like the tariffs themselves are introducing a new kind of risk or uncertainty that counteracts the usual safe haven dynamic.
So the traditional relationships are getting a bit scrambled. Okay, so we've got these powerful forces pushing and pulling on yields. Let's zoom out. What are the broader consequences, financially, economically, even geopolitically?
Well, financially, the big one is rising borrowing costs. And it's not just a U.S. thing, it's global. It makes things tougher for emerging economies that borrow in dollars, obviously. But even in places like Europe, household debt feels the squeeze. We're seeing it starkly in Japan, too. Their 30-year bond yields just hit a record high.
A record.
Yeah, and demand at their bond auctions was weak. So it gets more expensive for the Japanese government to finance its own massive debt load. It's a ripple effect.
A global tightening, essentially, driven partly by U.S. yields. And what about trust? Geopolitical trust in the U.S. system and treasuries as that bedrock asset?
That's where it gets really deep. The research points to a potential, maybe gradual erosion of sovereign confidence. You see countries like China slowly reducing their holdings of U.S. treasuries over time. Japan's actually the biggest foreign holder now.
Right.
And there's this phrase the market seems to be asking, is the U.S. Randy reliable or Randy reckless?
What does that capture?
It captures concerns about, well, policy predictability, the sheer size of the debt, maybe even worries about political stability, rule of law, the potential weaponization of the dollar. All these things feed into global faith, or lack thereof, in the U.S. financial system.
So it's not just numbers on a screen, it's about fundamental trust in the system's stability and predictability.
Absolutely. That trust is arguably the most valuable asset the U.S. has in the global financial system.
Wow. What an incredible journey through the world of U.S. Treasuries. It really shows how everything is connected. Debt levels, Fed decisions, trade spats, they all shift the ground beneath the global financial and geopolitical landscape.
It certainly does. And maybe that leaves us with a question for you, the listener, to think about. If this testing of global trust in the U.S. Treasury market continues, driven by all these factors we've discussed, what could that ultimately mean for the dollar's long-standing role as the world's main reserve currency? And following on from that, how might that shift begin to reshape the entire global financial map as we know it? Something to ponder.